Hello, Avila Advantage students. We are now in week 6 of finance, so we're quickly approaching the end of the course. Just want to remind you that for this week we have another exam, so your second exam that will cover chapters, or weeks 3 through 5 will be coming up. And I will have that out there on Monday. We don't have any forum discussion this week, so you can just focus on the exam, and then you will have your homework relative to chapters 12 and 13. I want to give you some insight for these chapters. Chapter 13 is a rather brief chapter with dividends, and Chapter 12 looks at the degree of operating leverage and degree of financial leverage, and we kind of multiply these things two together, what we call the degree of combined leverage. So one page that I want to point out in particular, your textbook in Chapter 12, if you look on page 393, they provide a nice summary there going through an example to explain first the idea of degree of operating leverage and the degree of operating leverage, and then finally the degree of combined leverage. Now, operating leverage ties in with fixed cost. The higher the fixed costs there are for a company, the more that's going to be required to break even, and that's what this initial first part of the chapter talks about, is how many units or how much in sales do I have to create in order to just cover those fixed costs. It's kind of like what we say an accounting break-even cost. This textbook just kind of looks purely at an accounting break-even. There's also other textbooks that look into the opportunity cost of breaking even, for just keep things simplified here. And it also makes some assumptions that we don't necessarily make in economics, that these relationships are somewhat linear in nature, that once you break even, you're going to continue to see this gap grow between profit. And that's not reality too, because you know from economics that we have these U-shaped cost curves, and that costs start driving themselves back up again. But for the sake of the example in the textbook, we're just going to keep it simple and just assume that these are linear in nature. So obviously big companies like Ford that have to produce a lot of cars before we cover any of those fixed costs. The idea is probably companies that do have a high degree of operating leverage, they do have a lot to break even, but once they get past that break-even point, probably their contribution margin or their profit margin is greater on each car once they get past that. Again, if you do have a low degree of operating leverage, you can probably break even a lot faster, but as your business expands, you might find that the contribution margin is less between each unit, because now maybe I start off with a small shop, and now I'm going to have to go out and rent more warehouse space, and this is increasing the cost of each unit that I produce until I can get to that ideal plant size. So now, with the degree of financial leverage, this deals with the amount of debt that the firm takes on. So one of the things that we know is that there is a benefit from taking on debt, and the fact that we can use the interest to deduct and lower our tax liability. And we can kind of in some ways magnify our returns, for our shareholders if we can use more debt and issue less stock. So as long as things are going well, I can use a lot of leverage, a lot of borrowing to help enhance those returns to the shareholders. So one of the concerns, though, is if I take on too much debt, well, the higher that degree of financial leverage, if things don't go well, the bigger the impact it can have on those overall earnings per share. And getting back to that page, 393, and they show that example with the Pierce Grain Company. Just to kind of point out for you, if you look at the degree of operating leverage, if we take the 120% change in EBIT going from the 20,000 to 44,000, that's 120%, and the percentage change in sales was 20% from 300 to 360,000. If I take 120 over 20, that's a degree of operating leverage of 6. And if I want to compare the degree of financial leverage, I'm going to look at that percentage change in this case, earnings per share, which was 150%. And if I divide that by the percentage change in earnings before interest and taxes, which was 120%, well, that would give me a degree of financial leverage of 1.25. And if I multiplied that degree of operating leverage of 6 times the degree of financial leverage 1.25, we would get a degree of combined leverage of 7.5. So it's saying in this example, a 20% change in sales, if I multiply that by 7.5, we result in that 150% change in earnings per share. So again, the higher this number, the higher degree of combined leverage, the greater potential risk you can think about too. So the greater the impact and fluctuations in profit, if you will. In this example, they provided a nice example for us to kind of show how we can calculate both of those items. So again, not necessarily a good or bad thing, but it just, different natures of different businesses and different industries may have higher degrees of financial leverage based on their ability to go out to the market and borrow debt. You have to remember sometimes the market dictates a lot of times how much debt can be borrowed. If you're an airline company, maybe you can issue more debt, but if you're a drug company that issues stock, mostly to finance yourselves, it's basically an idea that maybe has a limited shelf life, so you don't have any physical assets acting as collateral, so it might be harder for you to issue that debt. Okay, last thing to kind of wrap up a little time on Chapter 13. What you're going to go through is you're going to walk through some of the different theories of whether firms should pay dividends or not pay dividends. Most managers of big corporations don't want to go out and overpromise. So they generally keep their dividends fairly conservative, and if they feel that they can increase the dividend, they may do so at a gradual rate. One other part of this chapter I want to make sure you address, if we look especially on page 425, they talk about the kind of the payment process for dividends. Companies that do pay dividends usually pay them quarterly, and they notice they'll have a declaration date, a date of record, and a payment date, and there's that ex-dividend date. And the key point about that ex-dividend date is if you buy the share of stock on that ex-dividend date or after, you are no longer entitled to any dividend. So in theory, we should probably expect the stock price to decrease a little bit based on that dividend that you're no longer going to receive. Of course, there could be other factors that could increase the price or decrease the price in the market. But the reason they do this is to allow kind of the back office some time to kind of figure out really who does own that share. So it's usually 2 days after, well, this one they have September 24th, but at least 2 business days after the ex-dividend date, they usually have a date of record. So, but they also mentioned you could also have stock repurchases as another example. Instead of paying a dividend, excuse me, not stock repurchase, stock dividends that you can pay instead of a dividend. Stocks can occasionally split, and even corporations sometimes can buy that stock back in the form of a stock repurchase. The idea, if I repurchase some of those outstanding shares, there's fewer shareholders outstanding, so if there's a bigger pot of profit, I can share that more among the existing outstanding shareholders. So it's just different strategies that firms may take relative to dividends. So, and again, this chapter is a little bit briefer, but again, just kind of make sure you understand all the payment process. That's what I'll probably stress in one of the final exams. Well, I want you to have a great week this week. Do send me an email if you have any questions, but otherwise, talk to you online. And again, do send me an email if you do have questions related to homework. But again, we're quickly approaching the end of the course here, so just stay strong, and we'll talk to you soon. Take care.